You are listening to The Vocal Technologist. Spoken tech for your ears.
I swear, it feels like the fundamental rules of money are being rewritten almost weekly.
Oh, completely.
Every time you look, how we pay, who holds our money, or even what is doing the paying. It's all changing. And the founders behind this are moving at a terrifying speed.
And that's exactly what we're dissecting today. We're looking at three, I think, massive and interconnected shifts happening in financial tech right now.
Right.
The mission here is to use the latest intelligence to figure out the immediate impact and, maybe more importantly for you, what it all means long-term for how you spend and invest.
Okay, so we have a pretty packed agenda. First up, this huge infrastructure race, the battle for who owns your primary bank account.
Yeah, the incumbents versus the neobanks. It's a huge one.
Then second, we're going to get into the speculation explosion. I mean, the line between finance and just straight up betting is getting incredibly blurry.
With billions in capital flooding in. And then third, the big one.
The arrival of agentic AI.
This is a total game changer. It's not just about who pays, but what handles the transaction.
But, okay, before we get to the robots spending our money, we have to start at the bottom layer, right? The infrastructure.
Exactly. You have to start with how the money actually moves. And that means we have to talk about Fed now. It's not some future concept anymore. It's here.
And the big news this week is Capital One. They just plugged into the Fed's instant payments network.
Which is a huge domino to fall. Because Fed now is, well, it's the Federal Reserve's big upgrade for real-time 247 settlement between banks.
No more waiting till Monday for a transaction to clear.
None of that. And with Capital One on board, it just puts so much pressure on the holdouts, you know? Like Bank of America, they can't afford to be left behind.
And the system itself is getting more robust, right? We're not just talking small Venmo-style payments.
Not at all. Transaction limits are up to $10 million now, so this is becoming absolute table stakes for any big bank.
What's so interesting is that this is all happening while the so-called neobank revolution is in full swing.
Right. And those neobanks are selling this beautiful, cheap, easy-to-use experience on the front end.
But on the back end, they're basically renting the pipes from the old school banks they say they're disrupting.
Precisely. They partner with regional banks to get the licenses. It's a fascinating paradox. They're attacking the low-margin part of the business, the checking account.
And for a long time, the really big U.S. banks were kind of okay with that. They were almost happy to let those high-cost, low-profit customers go somewhere else.
It's a calculated risk for sure. But does that mean they're losing the next generation of customers? Cutting off future opportunities?
Well, that's the billion-dollar question. The big banks are betting on keeping the wealthy clients. But in the meantime, the neobanks are just winning. Look at Chime in the U.S.
Yeah, Chime is quietly becoming the #1 place people open a new checking account.
And it's not even that people are closing their old Bank of America account. It's this soft switching idea.
Exactly. You open a new account, move your direct deposit over because it's so easy, and suddenly that's your primary bank.
And Chime nailed it. With super simple onboarding, getting your paycheck 2 days early, no overdraft fees.
They hit all the major pain points of traditional banking. And if you look overseas, the scale is just, it's mind-boggling. Monzo in the UK.
Wow, yeah. Over 14 million customers now. They added 2 million in just 6 months.
40% year-over-year growth. And they serve 800,000 small and medium businesses in the UK.
And it's not just growth, it's the product expansion. They're becoming a whole financial hub.
Totally. Tax filing, ETFs, accounts for kids. They even have this cool undo payment feature. That kind of speed is what puts the pressure on the big guys.
And all of this takes a ton of capital, which is why we saw Revolut raise at a $75 billion valuation.
$75 billion. That is juggernaut status, one of the most valuable private tech companies in Europe.
But it's not all home runs, is it?
Yeah.
That's the flip side. You get Revolut, and then you get Curve.
Oof, yeah. The news that Lloyd's acquired Curve for what, 120 million pounds? A cut price deal?
That has to sting for their early investors. I mean, it just shows how thin the ice is. Not everyone makes it.
Absolutely not. And that razor-thin line between massive success and, well, a fire sale, it's a perfect transition to our next big shift.
The speculation frenzy.
Yeah, where we are totally rethinking how people can bet on the future.
This is where things get really wild. Prediction markets are moving from this weird academic fringe into the mainstream.
And Wall Street and Silicon Valley are pouring money in. They see these event contracts as the next big financial frontier.
You just have to look at Kalshi.
Unbelievable numbers. They just doubled their valuation to $11 billion. A $1 billion mega round right after a $300 million round.
The numbers are just hard to comprehend. Their trading volume is at $50 billion annualized.
Yep.
What are people even trading?
Specific verifiable things. Who wins an election? Will oil hit a certain price? Will a movie hit a box office number? It's a way to hedge against or just bet on things that normal markets don't cover.
But the big problem here, the elephant in the room, is legality.
It's the whole conflict, isn't it? Is this finance or is this just gambling with a fancy interface?
Right. And Kalshi is in a constant battle with state regulators about that exact question.
And the CFTC is weighing in, saying these markets need serious oversight, just like any other exchange.
But with backers like Sequoia, the momentum seems unstoppable. And that fight, finance versus gambling, it reminds me of another area where regulators are playing catch-up.
Consumer credit, and specifically, buy now, pay later.
Exactly. BNPL grew so fast, mostly outside the old banking rules. Now the government is taking a much closer look.
They're demanding data. Senate Democrats sent letters to, 7 of the big ones?
Yeah, Affirm, Afterpay, Klarna, PayPal, all of them. They want to know about users, and especially about late payments.
And they're pointing to CFPB research that shows BNPL users tend to be more financially vulnerable. They carry more credit card debt already.
The concern is this is just another form of short-term debt without the same protections.
Of course, the industry pushes back hard on that. They say their default rates are super low, under 1% in many cases.
They position it as a much more transparent alternative to a credit card with compounding interest.
But that scrutiny is forcing some of them to evolve. Look at Klarna. They're signaling a move way beyond just BNPL.
The stablecoin, Klarna USD.
Right. Built on a blockchain developed by Stripe, of all people.
So why do that? Why a stablecoin?
It's all about cutting the cost of cross-border payments. It's a clear signal that Klarna sees itself as a future global digital bank, not just a checkout button.
So you have Klarna using this new tech to build new rails, while Stripe, who built the original rails for the internet, is fighting regulators for a bank charter.
Exactly. Stripe is facing major pushback on its application for a national trust bank charter. Community groups, mainly, like the National Community Reinvestment Coalition, they argue it would let Stripe sidestep rules that are designed to protect consumers.
So even for the giants, extending your regulatory footprint is always a fight.
Always.
Okay, let's pivot to the final huge shift. This is less about who has the money and more about what is spending it. Agentic AI.
Right. And we have to completely rethink risk. Because an AI that acts on its own is fundamentally different from just asking ChatGPT a question. It's not semantic, it's a real difference.
It's AI is the new customer.
That's the perfect way to put it. And the big payment networks, Visa, MasterCard, Amex, through their standards body EMVCo, they're already standardizing agent-present payments.
Creating a global rulebook for AI transactions. So what does that look like in practice if my AI wants to buy something for me?
The agent gets what is basically a cryptographic passport. You, the user, authenticate once, maybe with Face ID, you set some spending limits, and then the agent uses a special delegated token to pay.
The key part of that is no 3D secure.
Right, that's the crucial detail. No 3DS.
For anyone who doesn't know, that's that annoying extra security pop-up from your bank where you have to put in a code.
Right, and an autonomous AI can't stop to fill out a pop-up. It breaks the whole seamless conversational flow.
Yeah.
Getting rid of that is the key.
Wow. But if there's less security, who's on the hook for fraud? The liability has to shift.
It does. It shifts to the issuers, the banks that provide the payment token.
Whoa. Okay, so if my AI agent gets hacked and goes on a shopping spree, my bank takes the hit, not the store I bought from.
As long as the merchant is using the new standard, yes. It's a massive incentive for the banks and networks to build really good AI-specific fraud detection.
That changes the entire risk model. And we're already seeing companies build for this.
Oh, yeah. Molly in Europe is already building out a full conversational purchase flow using OpenAI's payment API.
But not everyone is jumping in with both feet. I saw Adyen is taking a more cautious approach.
A merchant-first framework. They're making it clear they want the merchant to stay in control. And that's where you start to see the tension.
We're also seeing this blend of research and buying. PayPal and Perplexity.
Yeah, that's a great example. You can go from asking a question in an AI search engine straight to buying the solution with your PayPal account without ever leaving the page.
The AI gives you the answer and then helps you buy it.
And it's not just retail, it's reshaping core financial services. A company called Tidal Wave just raised $22 million for an AI mortgage platform.
They're automating things like income verification, underwriting, aiming to handle 4% of all U.S. mortgages by 2026.
We see it in investing, too. Public is rolling out an AI-powered brokerage to make research easier. These tools are just becoming standard.
Okay, so if AI is doing the buying, the advising, the underwriting,
Mm-hmm.
what is the big picture here? You mentioned this idea of gross domestic flourishing. What on earth is that?
Right. The theory is that AI will eventually hollow out a lot of middle-income knowledge jobs, and if that happens, consumer purchasing power could actually collapse.
So the old economic model of just getting people to consume more and more breaks.
It could. And this idea of gross domestic flourishing is what might replace it. The AI's goal shifts
Look at what?
from just optimizing for a sale to optimizing for your overall health, wealth, and well-being. Your AI agent would be programmed to help you flourish, not just help a merchant sell you something.
So it's not trying to get me to buy the most expensive mutual fund. It's trying to manage my portfolio for my long-term security.
Exactly. It becomes a true digital fiduciary, loyal only to you.
Which is such a fascinating contrast to the quiet giant in all of this, Apple.
Yes. While everyone is racing ahead with AI, Apple is slowly, methodically rolling out digital IDs, mobile driver's licenses.
They're playing the long game.
Yeah.
They're trying to do for identity what they did with Apple Pay.
Which facilitated something like $6 trillion in payments. They know that a trusted, verified digital ID is the bedrock for whatever comes next. They're betting that being patient and getting the regulation right pays off more than speed.
When you're building a $6 trillion network, I think that's a pretty good bet.
I would say so.
So to wrap up, we've seen all these tensions today. The raw speed of FedNow versus the slow, deliberate pace of Apple's identity project.
The battle between Chime's sock-switching success and the harsh market reality that Curve faced.
We saw Klarna pivoting to stablecoins to build its own future, while Stripe is still fighting for regulatory approval.
And of course, the blurring line between investing and gambling in prediction markets and the arrival of these autonomous AI agents.
All of these things are really about a fundamental shift in who holds the power and, maybe more importantly, who holds the risk in our financial lives.
These founders are forcing everyone, regulators, big banks, all of us, to draw new lines between what's considered stable banking, what's speculation, and what is autonomous commerce.
Which brings us to a final thought for you to consider. We know these AI agents are getting a cryptographic passport to spend money for us.
And we know platforms like Edian are insisting on a merchant-first philosophy. But we also just talked about how AI might need to evolve to optimize for your flourishing, for your well-being.
So what happens when those two things are in conflict? What does merchant first actually mean for you when the AI that's supposed to be loyal to you finds itself at odds with a merchant who just wants to make a sale?
That tension between the AI's loyalty to you and the merchant's bottom line,
Yeah.
that is the next great question in FinTech. And the answer will probably define how we all spend money for the next decade.
Spoken Tech for your ears.